Welcome to Iron Financial. Listen, if you are looking to forge a much stronger portfolio, absolutely cut through the relentless market weakness, and actually understand the real, raw mechanics behind corporate earnings, you are in exactly the right place today. I am your lead analyst, and right now we are running a brutal, no-nonsense stress test on a company that is currently pouring a staggering amount of concrete in the energy sector. We're talking about Constellation Energy, ticker symbol CEG. And hey, I'm your market skeptic. You know, my job throughout this explainer is incredibly simple. I need to figure out if the massive, glossy blueprints Constellation is showing the market are actually structurally sound. Because let's just set the stage for a second here. The AI boom, it's consuming power like literally nothing we have ever seen in modern history. Big tech companies are desperate for gigawatts of electricity to run these massive, sprawling data centers, and Constellation is aggressively stepping up to provide it. But my big question is whether retail investors are about to get absolutely crushed by a collapsing financial foundation that's desperately trying to fund all this. Is this real, sustainable strength we're looking at, or is it just highly leveraged hype? Well, we're going to find out right now. Today, we are testing three massive load-bearing pillars of this company. We're drilling straight into their Q1 2026 earnings explosion. We are closely inspecting the structural integrity of their $22 billion Calpine acquisition. And finally, we are stress testing their absolutely massive debt load. So, grab your hard hats. Let's get to work.
All right, we absolutely have to start right here. Notice this jaw-dropping figure, $1.59 billion. That is Constellation Energy's Q1 2026 GAAP net income. And look, when you talk about earnings growth in the utility and energy sector, you're usually talking about boring, single-digit percentage bumps. It's a slow and steady game, right? Well, this isn't just an incremental step up. This is a completely new financial skyscraper being dropped right onto the skyline. Operating revenues for the quarter expanded to $11.12 billion. Now, for the retail investor, GAAP net income simply means the official accounting standard, so it includes the whole shebang: the good, the bad, the core business operations, and yes, all the incredibly complicated accounting artifacts from their recent mega acquisitions. But the bottom line takeaway here is they didn't just meet market expectations, they poured an incredibly thick slab of profitability that has completely redefined their baseline.
Wait a second, hold on. Let's not break out the champagne on the construction site just yet. I see the $1.59 billion. It's huge. But here is the central question for this entire explainer. The thing we really have to figure out. Is this sustainable, load-bearing growth? Or is this just pure acquisition hype? Because we see this trap all the time in the market. A company wants to look like it has explosive growth. So what do? They go out and buy another massive company using an absolute mountain of debt. Suddenly, their top-line revenue looks incredible, but it's really just paper gains juiced by a buyout. Literally any management team can buy revenue if they take on enough leverage. So I need to know, are these real recurring cash flows forged in steel, or is this foundation going to crack the minute the macroeconomic winds start howling?
I hear the skepticism, for sure, but let's actually read the tape. In Q1 2025, Constellation's GAAP net income was $118 million. That's 38 cents a share. Exactly 1 year later, Q1 2026, it is $1.59 billion, or $4.49 per share. That is an explosive 1,200% increase year over year. Think about that for a second. That is a structural masterpiece in profitability. And it wasn't a market accident. They successfully expanded their fleet, seriously diversifying their generation capabilities. On top of that, they recognized favorable stock-based compensation and benefited heavily from their nuclear production tax credit portfolio. Market skeptic?
Okay, but it wasn't completely smooth sailing, right? I mean, they had way more planned nuclear outages this quarter.
Right, that's correct, and we have to factor that in. Nuclear outages cost real money and real time. You have to safely power down the reactor, refuel the entire thing, conduct intensive structural maintenance, and while that's all happening, Constellation still has to go buy replacement power on the open market just to fulfill their client contracts. It is a massive point of friction. But even with those heavy maintenance costs actively dragging them down, the sheer velocity of this top-line and bottom-line expansion is just undeniable. Their operational footprint is entirely different than it was just 12 short months ago.
So let's trace the historical foundation of their base business, because you can't bolt a massive acquisition onto a shaky framework and expect it to hold. You want to see real durability? Over a 6-year period, spending from 2019 to 2025, their total revenue climbed steadily from $18.92 billion up to $25.53 billion. That is a nearly 35% structural expansion over half a decade. That proves they can organically scale. And take a hard look at those 2025 margins, way before the massive 2026 acquisition numbers even hit the ledger. Total gross profit sat at an ironclad $10.85 billion against operating expenses of $7.77 billion. That yields a total operating income of $3.09 billion for the year. And this is the absolutely crucial takeaway here. This isn't some flash in the pan. The base scaffolding was already highly profitable. They were generating billions in operational cash flow long before Q1 2026 even kicked off.
Okay. But we just talked about how GAAP includes all those messy accounting artifacts. If I'm an investor sitting at home trying to figure out what the actual day-to-day cash engine of this company looks like, how do we strip out all that noise? Great question. You look at adjusted operating earnings. We are shifting over to non-GAAP numbers here to get a clearer picture. When we adjust, we strip out the things that don't reflect the daily ongoing business operations. Things like unrealized market impacts from hedging contracts, massive one-time integration costs from buyouts, and big nuclear decommissioning add-ins. When you clear all that accounting dust away, the pure operational engine still grew from $2.14 per share in Q1 2025 up to $2.74 per share in Q1 2026. But what's truly critical here, the thing you really need to pay attention to, is their forward projection. Management is currently targeting roughly 20% adjusted operating earnings growth on base earnings projected all the way through 2029. Let that sink in for a minute. A 20% compound annual growth rate means their earnings could essentially double in just 4 years. And that projection doesn't even include potential incremental long-term deals they might sign. It is built entirely on their current, reinforced base.
Now, let's pivot over to the real heavy lifting, the true driver of this massive Q1 surge. On January 7, 2026, Constellation finalized the acquisition of 100% of Calpine for a massive $22 billion price tag. To pull this off, they used $4.5 billion in cash they had on hand, and they issued 50 million new shares of equity. In exchange for all that capital, they bolted on 23 gigawatts of natural gas, geothermal, battery storage, and solar capacity. To put 23 gigawatts into perspective for you, that is enough electricity to power millions of homes, or, honestly more importantly for Constellation's strategy, several massive, totally power-hungry AI data center hubs.
Right, and here is exactly where I start seeing some severe cracks in the armor. $22 billion? That is a staggering amount of weight to suddenly put on a balance sheet. And 50 million newly issued shares? Come on, that is massive dilution. They essentially just printed millions of new slices of the company pie, meaning every single retail investor's existing slice just got smaller. But the real tripwire here, the thing that keeps me up at night, is the share lockup period. 50% of those newly issued shares unlock and become freely tradable in June 2026, and the other 50% unlock in June 2027. Let's explain why this actually matters. When institutional investors suddenly have millions of shares they are legally allowed to sell all at once, it can create a massive wave of supply hitting the open market. It's basic economics, right? If supply floods the market and demand doesn't step up to match it, the stock price tanks. That is a serious structural risk hanging right over the market's head like a giant wrecking ball.
Look, the lockup overhang is a completely fair point to bring up, but you really have to look at what they are building on the other side of the job site to absorb all that pressure. They are securing long-term structural revenue with literally the biggest tech companies on planet Earth. We have 2 massive 20-year power purchase agreements, or PPAs, detailed right here. A PPA is absolutely crucial in this industry. It is a multi-decade contract guaranteeing that a buyer will purchase power at a fixed price. It entirely removes the market volatility. First up, Microsoft signed a 20-year PPA to buy 835 megawatts of emissions-free power from the Crane Clean Energy Center. And significantly, this is backed by a $1.0 billion unsecured loan guarantee from the Department of Energy. That means the U.S. government is effectively co-signing the risk. Second, Meta signed a 20-year deal starting in June 2027 for a 30-megawatt uprate at the Clinton Clean Energy Center. They are locking in multi-decade guaranteed cash flow, fueled directly by the AI data center boom.
Okay, but locking in is a very, very optimistic phrase for a project that isn't even fully online yet. Let's dig into the Crane Clean Energy Center execution risks. The lead analyst calls it Crane, but let's just use its historical name so we all know what we're talking about. This is the restart of 3 Mile Island, specifically Unit 1. Now sure, Unit 1 ran safely for decades and was retired in 2019 for economic reasons, not safety issues. But it sits directly adjacent to Unit 2, which everyone knows is the site of the 1979 partial meltdown, the most infamous nuclear incident in U.S. history. The psychological and historical hurdle of restarting a reactor at 3 Mile Island is just immense. This isn't a simple plug-and-play turnkey operation. They have to pass a comprehensive, absolutely grueling safety and environmental review by the Nuclear Regulatory Commission. They need state and local permits from politicians who frankly may not want a nuclear restart in their own backyard. They face massive interconnection construction hurdles, and they still have to actually secure a renewed operating license. If any single piece of this regulatory scaffolding collapses, that 20-year Microsoft revenue stream gets severely delayed, or worse, evaporates entirely.
Execution risk is always present in mega projects for sure, but you have to understand that the federal government is basically providing the steel rebar to support Constellation's long-term margins while they build all this out. Let's break down the Nuclear Production Tax Credit, or the PTC. I want you to think of the PTC as a heavily subsidized insurance policy for profitability. In 2025, Constellation qualified for up to $15 per megawatt hour. This acts as a solid concrete floor. If wholesale power prices suddenly crash, the government steps in and hands them up to $15 per megawatt hour just to ensure the nuclear plants stay profitable. But hey, if power prices surge, Constellation doesn't need the help, right? So the credit is reduced by 80% of gross receipts over $26, and it phases out entirely once prices hit $44.75. And the best part? This floor is locked into law all the way through the end of 2032. This legislation effectively builds a massive concrete wall around their baseline profitability.
Well, a concrete wall is great, right? Up until the foundation sinks straight into the mud under its own incredible weight. Let's address the massive elephant on the construction site. $42.40 billion. That is Constellation Energy's total liabilities at the end of 2025. This is the sheer, raw debt load required to play in the big leagues of nuclear energy and corporate mega-mergers. It is a staggering amount of leverage. If you want to talk about stress tests, well, this is the ultimate pressure point. At Iron Financial, we never, ever ignore the debt side of the ledger. We are living in a macroeconomic environment right now where interest rates are staying higher for much longer than anyone originally anticipated. Can a company really carry $42.4 billion in liabilities into a volatile interest rate environment without buckling? Because debt servicing costs eat directly into your cash flow, and if borrowing costs spike, that beautiful profitability narrative we've been talking about changes real fast.
And let's actually break that debt trajectory down for a second. That $42.4 billion, that represents a 7.6% year-over-year increase from 2024. The liabilities are physically expanding. The debt load is growing heavier by the quarter as they take on these massive, ambitious projects like Calpine and the TMI restart. Okay, but you cannot look at liabilities in a vacuum. You just can't. You have to look at how management is aggressively defending the equity at the same time. They aren't just hoarding cash and hoping for the best here. They are actively reinforcing the shares. In April 2026, Constellation entered an open market repurchase program. Year to date, they've deployed roughly $335 million. Cumulatively, since separation, they have deployed about $2.7 billion to repurchase 18.5 million shares. Let's make this really simple. By buying back and retiring 18.5 million shares, they are actively shrinking the float. If the company is a pie, they are reducing the number of slices, which means every remaining investor slice just got intrinsically larger and more valuable. It artificially boosts earnings per share. So yes, while the debt is absolutely growing to fund massive asset expansion, management is simultaneously increasing the density and the value of the remaining equity. That is a highly calculated financial defense.
And listen, if you think that $42.4 billion is keeping the bond market awake at night, you need to review their credit rating armor. Constellation currently holds a BBB+ rating from both S&P and Fitch, and a Baa1 rating from Moody's, all of them with a stable outlook. For those of you outside the bond market, BBB+ is solid investment grade. This is absolutely crucial. It means massive pension funds, huge endowments, and institutional banks are legally permitted to buy and hold their debt. Because it's investment grade, Constellation can access capital and finance huge acquisitions like Calpine at highly competitive, very low interest rates, unlike some companies that are forced to issue incredibly expensive junk bonds. The credit agencies have run their own brutal stress tests, and they are telling the open market that Constellation's balance sheet is heavily built to handle the load.
All right, it's time to synthesize all this data and issue the final verdict. Let's head over to the trading desk. On one side, we have the Iron Foundation. The PTC margin support provides a guaranteed rock-solid cash flow floor through 2032. The $22 billion Calpine deal immediately bolts on 23 gigawatts of incredibly valuable capacity. And they have multi-decade structural PPA agreements with Microsoft and Meta, literally locking in future revenue. The core business is proving to be a cash-generating machine. Hold on, but you absolutely cannot ignore the structural risks heavily weighing down the other side of the ledger.
$42.40 billion in liabilities is a heavy anchor, especially in a high-interest rate environment. The Korean Clean Energy Center, restarting 3 Mile Island, faces totally unprecedented regulatory and execution hurdles. You have institutional share dilution from the Calpine deal, with those lockups expiring and actively threatening to flood the market over the next 2 years. Plus the ongoing financial drag of planned, highly expensive nuclear outages. There's a massive amount of friction actively working against this whole growth narrative.
So, here is the ultimate question for your own portfolio. We've laid out the blueprints, we've violently tested the stress points, and we've run the hard numbers. Will the tech sector's totally insatiable AI energy demand justify the massive $42 billion debt load, proving this industrial powerhouse is truly forged in steel? Or will regulatory red tape, painful execution delays, and massive leverage prove this is really just a structurally weak trap waiting to crack wide open? That is the trade decision you have to make today. Analyze your risk tolerance, deeply respect the data we've shown you, and build your positions accordingly. Thank you for tuning in to this explainer from Iron Financial. Keep your foundation strong, and we'll see you in the next analysis.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.